Welcome to Section 6 of the ASC 225 Income Statement Training Series. In this section, we explore discontinued operations, a special category of income statement presentation that separates disposed or held-for-sale business components from the results you expect to see again next year. Understanding this distinction is essential for accurate financial reporting and analysis. By the end of this section, you will be able to define what qualifies as a discontinued operation, apply the 6 held-for-sale criteria, identify how a SU 2014-08 changed the rules, prepare the correct income statement presentation, and measure disposal group assets appropriately. These skills directly affect how your organization reports significant business changes to stakeholders. Think about what financial statements are really for: helping users predict future performance. When a business unit is being wound down or sold, its results tell us nothing about what to expect next year. That is the fundamental reason GAAP mandates separate presentation. Blending a one-time factory closure gain into normal operating income would mislead anyone using the statements to forecast. Separation is not just a formatting rule, it is a transparency requirement. 2 conditions must both be true. First, the item must be a component, meaning operations and cash flows that can be clearly distinguished from the rest of the entity. Second, it must be disposed of or classified as held for sale. Meeting those 2 conditions alone is not enough. The component must also satisfy at least one of 2 additional criteria. It represents a strategic shift with a major effect, or it is a newly acquired business classified as held for sale from day one. Both gates must be cleared. This is the change that trips up many preparers. Before a SU 2014-08, under old SFAS 144, the sale of almost any separable component could trigger discontinued operations treatment. The standard was intentionally raised. Now the disposal must represent a strategic shift. Think exiting a major geographic market, abandoning a core line of business, or divesting a significant equity method investment. Selling off a single underperforming product line or a regional office generally will not meet the bar. When in doubt, document your assessment and err toward caution. Concrete examples help anchor the strategic shift concept. Qualifying scenarios share one characteristic: they fundamentally reshape the entity's future earning profile. Exiting an entire country's operations, selling off a core business segment, or disposing of a significant equity stake all meet that bar. Contrast those with the routine divestiture of one product line among many, or closing a branch office that represents a fraction of revenue. The question to ask is always, does this change how analysts and investors should model this company going forward? Held-for-sale classification under a SC 36010 is an all-or-nothing test. All 6 criteria must be satisfied simultaneously. Management intent alone is insufficient. The asset must be genuinely ready to sell today, not after renovations or restructuring. A buyer search must be underway. The timeline must be realistic. Completion within 1 year is the default expectation. Pricing must reflect actual market value, not an aspirational number. And the commitment must be firm. One missing criterion means the asset stays on the balance sheet in its current classification. The 1-year completion requirement is a firm default, but GAAP recognizes that circumstances beyond management's control can arise. Regulatory approvals, unexpected market collapses, or buyer financing failures can all extend the timeline without invalidating the classification, provided the entity remains genuinely committed to completing the sale. The critical word is documentation. If you are relying on an exception, your work papers must capture what happened, why it was outside management's control, and the evidence that commitment remains intact. Undocumented exceptions invite audit challenges. Once a component qualifies, the presentation rules are precise. Everything, revenues, expenses, gains, and losses of the discontinued component collapses into a single line, already net of its tax effect. That line sits below the continuing operations subtotal, clearly labeled discontinued operations, net of tax. You cannot bury it in operating expenses or blend it into other income. Earnings per share must also be bifurcated. Basic and diluted EPS for continuing operations, and separately for discontinued operations, both appearing on the face of the income statement per ASC 260-1040-53. Walk through this illustrative example. The entity earned $260,000 before tax from continuing operations, paid $65,000 in related taxes, and reports $195,000 from continuing operations. Below that line, the discontinued segment contributed $75,000 of operating income, already net of its $25,000 tax, and a $45,000 gain on the disposal itself, net of its own $15,000 tax. Those two discontinued amounts total $120,000, bringing net income to $315,000. Notice that each discontinued component discloses its tax effect parenthetically, giving readers the gross amounts if they need them. Assets and liabilities in a held-for-sale disposal group are measured at the lower of carrying amount or fair value less costs to sell, abbreviated FVLCTS. This is essentially a net realizable value concept. What would you actually put in your pocket after commissions, legal fees, and closing costs? The moment you classify assets as held for sale, depreciation and amortization stop. The asset's value is now driven by the market, not by consumption. Remeasure at every balance sheet date and recognize any impairment immediately. Recoveries can be recognized, but only up to the cumulative impairment previously recorded. Let's lock in the essentials. Discontinued operations treatment is reserved for disposals that represent a genuine strategic shift. ASU 2014-08 raised the bar significantly. Every one of the 6 held-for-sale criteria must be met at once. On the income statement, the results collapse into a single net of tax line below continuing operations, with separate EPS disclosure. Assets stop depreciating and are written down to fair value less selling costs if lower. And remember, document your assessment every period end, even when your conclusion is that nothing qualifies. That documentation is your audit trail. Thank you for completing this section on discontinued operations.